All our partners are entrepreneurs or have a really entrepreneurial mindset, and so they don't have the time to do all the research and the investment, but they also like that we are in those smaller companies they can understand, that they feel connected to. So I think that's the differentiator for us. Mainly, we have zero management fee structure, only performance fee, like the Buffett partnerships, 0.625. I think that's also something that's pretty fair to our partners. When they make money, they'll be happy to pay us. And if we don't execute like we should, then we don't get paid. It's Cake Box. It's also a company I think that's misunderstood. They had accounting issues, and it wasn't really accounting issues. Everyone thinks it's accounting issues. It's just.
Dear viewers of Good Investing Talks, it's great to have you back at the podcast, and it's great to welcome Sam Hollanders for the first time. Hi, Sam.
Hi, Tillman. Great to be here.
Sam, who are you?
I'm pretty straightforward. I'm a family man. I have a wife, 3 lovely daughters, and I'm a value investor. So that's the short version. I should elaborate on that. I didn't start my career off as an investor, but as an entrepreneur. We owned photo shops with the family. First my father, and then my sister and I took over. And I started investing because of some extra classes I took to have enough knowledge about management. And there I had a professor who compared a great Belgian company to one that went bankrupt due to fraud. And when he made that comparison, I thought, well, this is something I want to do. This is something I really like. And that was in 1999, so just before the dot-com crisis. And then in the dot-com crisis, my father lost a lot of money on the stock market. And that's when I decided to do all the investing myself. And then I started reading about Buffett, Munger, Philip Fisher. I tried trend following and other types of investing, but it really clicked for me when I read the little book that beats the market by Joel Greenblatt. I thought it was so easy to just buy good companies at great price, and having the sliding scale as well. So not only cheap companies and not only quality companies, but it is a sliding scale. What you pay is that really clicked for me. And then in 2008, I made more money in the stock market than with the photo shops, and that's when I decided to go full-time in investing. And in 2011, I started an investment newsletter. I wrote that for, I'm still writing it, by the way, but I wrote that for almost a decade until I decided I wanted to step up and start a fund. And I wrote in the newsletter that I want to start a fund, and I didn't want to do it alone. So I wrote that, and half an hour later, my current partner, Joel, called me and said, well, let's talk about this. I just sold my company, and I don't like how big banks invest. I want to have more skin in the game. I want to invest like an entrepreneur. And then we got together, met a few times, and after 3 meetings, we jumped. We started a fund. That was in 2020, just during full Corona. So that was not as easy as expected. And then last year, we transferred from a compartment in a fund to our own structure in Luxembourg.
What does the fund that's under umbrella of Chess Capital stand for? Or what does Chess Capital stand for?
Chess Capital is value investing, mostly small mid caps. Family owned is also pretty important for us. So not only family owned, but strategic ownership is a big focus. We do not invest in emerging markets, but we don't like to limit ourselves regionally. So at the moment, we are pretty heavy invested in the UK, in Scandinavian countries, but we also
kind of emerging markets. Sorry, I've lost too much money in some UK stocks. I'm a bit worried.
It's the AEM market is a pretty tough market. Yeah. Certainly since Brexit, but I think that's where the opportunities lie now. So it's easier there to find good opportunities, good companies at really great prices at the moment. So that's just emerging markets. Emerging markets. I mean Poland. If you see Poland, they have great companies as well, but the legal structure is still pretty different. So that's one country we don't invest in. for example. So that's what we call emerging.
Um, why did you pick chess as a inspiration for your partnership?
That's double. My partner Joel was a pretty great chess player in his youth. He was in his yeah. I don't know his ranking, but he was pretty good. And he also had a non-profit organization that was called Go for Grandmaster, and they were educating young people. I think being ages of 12 to 16, and they wanted to produce the first Grandmaster in Belgium. So they did so. I think about 2 years ago. It was finalized. So that's the connection for him with chess, and my connection with chess was in my investment newsletter. I needed a way to rank stocks because I used the sliding scale of Joel Greenblatt, going from really almost net stocks to great quality companies, and I needed a way to rank them. So the really great companies are the queens, and then all the way down to the pawns, the turnaround stories that if they reach the end of the board, that can turn into queens. So and then the rook bishop are in between. So that was the connection for me, and then Joel, and then yeah, it was just too easy to to pick that name because investing is also kind of like a strategic game.
Coming back to the family business, the Photoshop business you did own, how did it help you to become better as an investor?
I think we look more at both Joel and I. We look at the business. We look at the managers, the culture of the business more. I think than people just straight out of school. I think they look more at the numbers. That is the feeling I have. I don't know because I didn't come out of school this way, but it's for us a stock is a business, and all investors say that, but I think we have that more in our core than other because we were entrepreneurs first. As Buffett said, if being an investor made me a better entrepreneur, and being an entrepreneur made me a better investor. So I think that's true. That applies to us as well. We weren't formed with efficient market hypothesis or anything else. We just look at the companies. It's easy to keep a clear head that way.
You were in the mess that's called making a business where things blow up from time to time. Quite normal.
Yeah, and for me, with the photoshops, we had the digital uprising of the photos. So in the photo business, you didn't earn anything selling equipment. It was ridiculous margins of 1.5 to 3%. We had big Dutch companies, big German companies entering our markets. The margins were gone, but you earned on the printing of the photos. So I learned in that the disruption that can happen in businesses. I learned that early on, and that you need to move, that you need to be flexible. If you look at Microsoft, they almost had to reinvent themselves. They had their base of Office, but they had to reinvent themselves to become the company they are today. Apple as well, from computers, they still have computers, but they're the company they are now because of the iPhone. It's also reinvention, and that's something I learned early on as well. And for some reason, I don't know why, but Joel was also in telecom. So they were specialized in um, equipment for hospitals. But yeah, also there, it's the constant disruption. That's why you won't see us invest in high growth stocks or anything, because we learned the hard way sometimes that disruption is fast and very easy to be there. So that's also something we learned as entrepreneurs.
Coming back to the fund, what is your why for starting a fund?
That's actually a pretty difficult question. For me, the moment I wrote it in the newsletter was a moment of frustration. I always have the sliding stocks, so the real quality companies, and then the pawns that were there, the nets, the ones, the turnarounds, the one that yeah could as easily go bankrupt. And at some point, I just received an email from a reader that he had invested way too much of his money in one of those riskier stocks and not in the others. And he was mad at me because I suggested that stock, even it was for only 1% of the portfolio. And at that point, I was up that year about 18%, and he lost money with the same stocks in his portfolio as I did, just because of the capital allocation. So that was a frustration that I wrote off in the newsletter, and that was actually the start of the fund. Um, the rest is more, I think, when you have the fund, and also the book I wrote, you are taken more seriously by other investors. So it's easier to communicate with other investors and network. That's also a big part for me. That's a nice thing to have as a fund investor. But and for Joel, I know it was just his way. He didn't want to have the standard investments of the big banks. He wanted to really act as an entrepreneur, but still not do private equity. So that's we invest in sometimes pretty small companies, only 80 million euros market cap, and then you feel like you really can influence them. If you write them, you talk to the CFO, the CEO yourself. You don't have investor relations in between, and yeah, so the entrepreneurial aspect as well.
So you found a customer problem. Like first you build a fan base with your newsletter, then you found a customer problem and built a product to solve it. I think it's called entrepreneurship.
Yeah, for me it was, if I write about it and people don't do what I write, then it's their choice. Of course, it's their choice. It's their portfolio. They decide what they buy, what they don't buy. But for me, the it was this the problem that was solved was, now I am responsible. I'm the sole responsible for the investment decisions, the allocation decisions. If something goes wrong and then the numbers are bad, which happened actually in 2022, it's my fault, and I can't blame anyone else. So yeah.
With your partnership, what kind of value do you want to bring to the marketplace of funds?
Um, Actually, we want. I think our biggest thing we do, not different than anyone else because others are doing it as well, but the most is the communication with our partners. We send out a newsletter every quarter, and we detail what stocks we bought, why we bought them, what stocks we sold, and why we sold them. So pretty straightforward communication. That may be something I got from the newsletter writing before, but that's something I think it's really important. All our partners are entrepreneurs or have a really entrepreneurial mindset, and so they don't have the time to do all the research and the investment, but they also like that we are in those smaller companies they can understand, that they feel connected to. So I think that's the differentiator for us mainly. And then there's our cost structure as well. We have zero management fee structure, only performance fee, like the Buffett partnerships, 0.625. I think that's also something that's pretty fair to our partners. When they make money, they'll be happy to pay us, and if we don't execute like we should, then we don't get paid. So that's also, I think it's a differentiator. There aren't that many of us with zero management fee funds.
Why are you offering a fund solution that could be better than other offerings in the market you're competing with?
I don't think, yeah, better is such a difficult word. I don't think maybe it's better than others. It's just, it's different. It's us, and people that feel connected to us will like our fund more. As I said, it's all entrepreneurs that are in our fund. So I think that's the main differentiator, and that's I don't want to call it better. It's just different. I think a lot of value investors, we're all doing the same thing, and one will focus on that stock, and another one will focus on that stock, and one year one will outperform than the other compared to the others, because sometimes the market decides to keep your stocks low, and then sometimes it decides that your stocks go up at different times. So yeah, I think value investing is maybe the factor that makes it better, because I still believe that reversion to the mean is still a thing. We see a lot of passive investing and quality investing now. Growth investing was also with all the tech stocks. I believe it's time now for a turnaround that the value will come up. But yeah, I don't think necessarily better, but just different. I think people will understand if they read a partner letter, for example, on our website. Then they will understand what we do, why we do it, what motivates us. And I think that connection between us and the partners is what makes it better. Because I think our partners understand what we do and why we do it, and they will keep participating even in periods when the fund isn't performing as maybe other funds. So they won't get out at the worst time at the bottom, and they don't come in at the best time at the high. And that's why I think it's better because of the communication, but not necessarily investment wise. I don't think we can differentiate with others. It's just personal thing, I think.
Adding to this, what is your competitive advantage as a fund manager?
To private investors or other fund managers, because I think because it's just the two of us against other funds, we have a very fast investment approach. I'm primarily focused on the research, and then I discuss everything with Joel, and then we decide what to buy. That can be in 1 or 2 days. Sometimes research go that fast. Sometimes it takes a few weeks, but we don't have a committee that needs to decide. It's just the two of us. So I think not that we trade that much. That isn't a factor, but we can decide pretty fast. And then also because we are small, we still have the opportunity to invest in those pretty small companies that the others overlook. Um, and because we, as I say, we communicate a lot with our partners, and actually even some have refused some investors because we didn't think they have the right mindset. We don't have that quarterly or monthly target to hit. Um, they're okay with us if we underperformed in 2022. They're okay with that. They know why. Um, and that's that timing issue that a lot of fund managers have, that they need to perform or compete against others. We don't feel that pressure. And if we feel that pressure, it's not coming from our limited partners, it's coming from ourselves. So I think that's also a very big competitive advantage that private investors also have. That's why I asked private or fund managers. Private investors don't need to perform against against the benchmark each quarter as well, and we don't compare ourselves to a benchmark either. We have set ourselves a nominal goal of between 10 and 18% compounded annual growth over a period of a decade. And that's the target we need to hit. So if the Standard & Poor or the Euro Stocks does better or worse, yeah, we don't really care. We don't compare ourselves.
You already mentioned it a bit, but what is the investment strategy of Chess Capital?
We have three segments in our fund. Because we are in those pretty small stocks, the liquidity isn't always that high. And to be able to meet redemptions or inflow of capital sometimes not at the right time. If the stock market was high, like in 2021, we had a big inflow of capital, and then you need to place it somewhere. And if you don't have good opportunities, and that's why we have a portion, about 20-25% of portfolio is in holding companies like Exor, Investora, B, Sofina. They provide the needed liquidity, and they're also just great companies. And we were able to buy them at that very opportune moment. So that's a part of the portfolio. Then we have the quality stocks. We call them our core positions. It's for the moment it's 4 of them. They are the biggest positions in our fund. They are between 5 and 8% of the fund. That's the positions we always want to buy at a decent price. We don't overpay. We don't pay for growth that might be, as I said, the disruption is so set in our brain that we're always pretty on the safe side with the margin of safety. But those core positions are quality businesses, and then we have what we call the value plays, and those are leaning to quality, but they can also be just cheap. For example, we bought Euronav, the tanker company, at around €6, trading at half book value. Um, Sold them when they reached F14. Didn't go in the trading war. The same with the retail, real estate in retail. Wereldhaven in Holland, it was trading at 0.25 times book value, and book value was too high, but it was just ridiculous. So we bought it at 0.25, sold at half book value. Those are the value plays, but the value plays range from that opportunity to also what sometimes others may call quality plays, or companies that grow at 6, 7, 8% a year, but then we still buy them when they're low, and those are the ones we sell when they reach intrinsic value, the fair value, as opposed to the core positions. At the core positions, we will keep longer. We need to have a premium, maybe 30, 40% above what we calculate as intrinsic value, because we don't want to trade in and out of them a lot. Because a lot of the time with those really quality companies, you see that the stock market goes up. Those companies get overvalued, but if you sell them, you never get a new opportunity to buy in them, and they increase their value from growing internally. So you never buy them cheaper than when you sold. So that's the duality in our portfolio. So the maybe you can call it the new Buffett after Charlie Munger, and the old Buffett before Charlie Munger. We use the two approaches.
So, what kind of investments make you really passionate? So, maybe you can go back in time, remember one or two situations where you've been really passionate about investment and could not stop thinking about it. Even went to your wife or your two kids to tell them about it. Oh, I found this investment. Yeah.
Well, the one I always tell the kids about are the but that's a private investment. That's actually not in the fund because it's even too small for the fund. It's a small real estate company in Belgium, and when I have three daughters, so there's a lot of shopping, and when we go to the not the shopping malls, but the high streets, the streets in the cities, and we pass one of those buildings that they own. I always tell them that's we own a piece of that. We own a piece of that, and that's something as well, that I think is a very nice thing to do with your kids, because then they realize first of all what I do, because otherwise when they were younger they always thought I was playing games on the computer instead of reading and investing. So that helped. So and yeah, that's something I'm passionate about as well. Real estate investing. That's something I got from my father. But then company wise, well, one of the investments is in the photo business, smart photo. That one is one I followed for a very long time, and that's just because we saw it almost go bankrupt and reinvent itself, go into personalized gift instead of photos, and grow again. Um, that's also the one I discuss a lot with the family because we when we order gifts like those coffee mugs with the photos on, I think they're great to have them here for when family comes. Friends and family have their own mugs here with their own pictures on it, so that's a fun thing. Um, then one that I am passionate about because I think the world misunderstands it is also a very local company. It's 10 miles from where I live, the headquarters. That's CPEF. It's a palm oil company. So I think palm oil is misunderstood. Everyone sees it as the business that drove out the orangutans and other monkeys and other always the bad part. Cutting the forests. What people don't see is that palm oil is much more efficient than soy or sunflower or anything else. So if we want to feed the whole world, we need to invest in palm oil, do it the right way, of course. CPEF is a company that does it the right way, locally, engaging with the community, building schools for the community. So yeah, that's something I'm passionate about as well, because I think it's really misunderstood. I'm thinking of others in the past, the holding companies, I think, is as well, but that's more not for the fund, but for private investors. I think a lot of private investors are now looking at passive investing, ETF investing. And I think if you look at the holding companies like Investor AB, Exor, and you Ackermans van Haren in Belgium, if you put your money next to all of those rich families having the money to have the best employees for research and everything, I think it's very difficult to go wrong with that. So that's also one of the passions. That's also why they're in the fund for a small part. The holdings they provide liquidity, but you also see that they just perform well. And then most recently, it's Cake Box. It's also a company I think that's misunderstood. They had accounting issues, and it wasn't really accounting issues. Everyone thinks it's accounting issues. It's just the founder and the CFO, the co-founders. They started with one cake box shop. It's egg-free cake. They're of the Hindu community, but even not all Hindus. It's even a small part in the Hindu community. They don't eat eggs. Okay.
Let's talk
And
about this a bit later. I have to stop your passion
okay.
for a second because we want to go deeper into Cakebox a bit later. And maybe let's try to invert it. What is the most boring investment framework or scheme you have in the fund, but that works and where you don't have that much passion about it, but like think it's just a helpful thing that works for you?
Wow. I always research the companies, and they always have something that I like, because I think the most boring is if, for now, the construction companies. I think with rents, with inflation, and I don't mean rents. Oh wow, I'm looking for the word. And that, yeah, rente, interest rates. That's it. With interest rates going up, yeah, sometimes I space out in English. I don't know why. With the interest rates going up, you see that construction companies are hit very hard. You have construction companies that are now at half book value, or even 30% of book value. And if you see that there's still difficulties in housing in Germany, I know there's not sufficient housing or decent housing in UK as well, Sweden, yeah, and we bought three different construction companies, one in Belgium, one in UK, and one in Sweden. Um, the one in UK is the most solid one. The land bank is just there. If they don't develop now because people can't afford it, then they will develop in maybe 2, 3 years, 4 years, 5 years. Yeah, we actually don't care. It's just now it's a waiting game. You bought them at such discounts that you just have to wait until either the interest rates come down or people can afford better housing again. But the troubles we have, old housing that needs to be remodeled, old neighborhoods that need to be remodeled as well. You see them in the UK pretty much. The all housing blocks that are just bought up and redeveloped with new schools, with new shops. Yeah, that's something. Yeah, that's maybe the most boring part, because once you bought them, it's just, yeah, now we have to wait, and that's something you can't control, interest rates. So yeah.
Hey, Tilman here. It's great that you've made it that far into the video, and I think it shows a certain passion for investing you're having. If you want to dive deeper and go further down the rabbit hole, you're invited to apply to my community, Good Investing Plus. It's a place that's very helpful to people who are ambitious about investing. It's helpful to investment talent as well as experienced fund managers. So if you're interested, please click on the link below. And now, without further ado, enjoy the conversation. What are reasons why you don't invest? We talked a lot about like the positive factors, but if you get to know a company, what makes you pass?
If yeah, if you don't understand it, that's always the easiest answer. For example, banks. I think banks are very difficult to analyze. What's kept off book, what's on book. So that's something we pass on. Um, for the rest, it's high debt is also a no go for us. As I said, we have the disruption ingrained in our minds, so we know that companies that have a lot of debt can go bankrupt. A company without that it's very hard to go bankrupt. It still can, but it's very hard. So we want our companies to be flexible, and I think if you have too much debt, you can't be flexible. And then I think the highest no go for a company is the management. If you don't like or trust the management, yeah, I think that's most important factor. I can give an example if you want a very big example. I don't like. I never invested in Tesla because of Elon Musk. I think what he did with the 420, he said we have a buyer at 420, and there wasn't a buyer. And then he raised capital when the stock price went higher. I think that was such a non-trustworthy move that I didn't ever look at Tesla again as a company that could be bought. Yeah, that's maybe the highest profile profile one, but yeah. So that even if if it becomes to be the best car manufacturer in the world, you won't see me buying it. I don't feel like I can trust him.
What happens before you turn an idea into an investment, or what usually happens?
If yeah, I read something about a company I like. I have different ways of finding companies. One is reading a lot, of course. I think that's for all investors. Then seeing what other investors do as well. If they have great new ideas, let's look into them. And then the others is screening, just the real basic screening, putting factors in. And then when a company comes out, the first thing I look at is the balance sheet. So as I said, debt is a pretty high factor for us. I also think you can see in the balance sheet a lot more than people think. If you see a growth in book value, tangible book value, you know the company is earning money, and you know that uh, it doesn't matter. It's reinvesting the money as well. So you don't have to look at the profit and loss statement to see that the company is making money. So the balance sheet is first for me. I like companies, industrial companies, companies with assets, something you can fall back on in if needed to be. After that, it's of course the profit and loss and the cash flow statement. And if I like the numbers, then I look into the management. What have they done? Are there strategic owners, and so on? But that's I already know what the business does because it has to get me interested. So yeah, that's maybe first what does the business do? How does it make money? Then the balance sheet, profit and loss statement, cash flows, and then management and company culture as well. I think if we have such a luxury position these days that we don't have to leave our home to get to know the company culture. You can find online. There are websites that rank companies, uh, disgruntled employees that put things online. You can learn a lot about the company just from behind your computer. So.
What is the aspect you spend the most time on in your research process?
Um, then it's the business itself. What does it do? How does it make money? Who are the competitors? Why is this company better or worse than its competitors? Where can it do? Maybe can do better. Maybe it's an easy fix. And that if it's trading very low, then a lot of companies. If you're really on that side of the aspect, the value plays, the real deep nets, then you know that there's something wrong with the company. Is this something you can see that's easily fixable, that the management can fix? So that's the business itself. That's the first part, and then after that, a good hard look at the numbers, trying to look for the so-called red flags. Is there something wrong with the numbers? Are they manipulating earnings figures? Um, maybe a simple example of something that I don't like is if you see a company reporting numbers, and in the past when they were growing, they were always reporting 9% growth, 10% growth, and at some point that the numbers aren't that great, and they just mention the number of the revenue, and no longer the rate at the growth or decline. Uh, that's something I think then they're hiding something. It's something I don't like to see in company presentations. I like to be the management to be straightforward and saying that, well, it is not as good as last year. That's why. If they made mistakes, I want them to earn those mistakes and say why. So that's the second part in the annual report. Just reading through the first one of last year, and then some past years as well. Um, Not starting backwards, but sometimes just going 5 years back, seeing what they said then, what was their thinking of growth back then? Did they execute on it? Did they, if not, do they come back to it in the next year and give us the reason why they didn't execute? Yeah, that's I think that's the biggest part, the annual reports itself.
You mentioned 5 years. Going back 5 years and comparing it to now, what kind of research aspect do you now spend way more time than before?
Uh, than 5 years ago, it's maybe I think the management more, because the companies have the focus is a bit more on smaller companies and family owned companies. And if you are in the family owned companies and they own sometimes 50, 51%, well, they decide everything. As a small investor, even as a fund, you will own maybe 1% of the company, and you have to realize you don't have anything to say. You can make suggestions, but you don't have any influence. So focus on who they are is bigger than 5 years ago. 5 years ago was maybe more a quantitative approach, maybe more than numbers. So it's more from numbers to people, the switch. But not it's not that big a difference. But yeah, maybe just a bit more.
So let's go from people to cake.
Yeah.
I, I promised to talk a bit more about Cakebox, one of your larger holdings. What kind of problems is Cakebox solving as a business?
They as I said, they produce egg-free cake, so that's their differentiator. There's only one other company in the UK doing the same thing. Um, a copy, almost it's a copy. It's even using the same colors for their shops, um, and they started off as two Hindus. A small part of the Hindu uh, can't eat eggs because of their religion, and that's why they started the cake box shops. They started the shop themselves, one, and then the CEO and the CFO both had one, and then after it became a franchise. But it's just the egg-free cake. They found a way to still have good tasting cakes. I'm calling it good because when in Europe, the cake box wouldn't work in I don't know, Germany's cakes or
We
that
have a
well,
lot
but
of bakeries, so it's hard to.
yeah, so I think it's pretty good as well. What I remember from holidays is, but in Belgium, in France, cake box wouldn't work. It just isn't tasty enough. But in the UK, the standards are different. Uh, they have maybe a different taste palette. I don't know. We tried the cakes and they're okay, but they're not as good as we are used to. I'll say it like that. Maybe that's better. But the egg-free cake, it was a real difficulty to make this the sponge that it's based on. That was the hard part to make without eggs, and they found a way to still make it and still have it tasty. Um, so that's good for the that part of the Hindu community. That's how it started. But now also vegans are coming to their shops as well. So yeah, that's a real solution for them. And I think the way they do it is they bake the sponges in factories, 3 points in the UK. Those go to the shops, and then the shops make all the fresh ingredients on them, the whipped cream or and fruit and all those things. So they found a way to do it fresh as well. So
Why did you find Cakebox an interesting investment? And how do you want to make money with it?
for now, the only money we make with it is the dividend. They have a pretty high dividend because it's franchise. They don't need that much money to reinvest. Um, that's the way we have made the money as for now. But we hope to make an exit sometime when they are valued at the correct price. I think it's undervalued now, and the reason they're undervalued is because they had not accounting issues, but they grew too fast. As I said, the CEO and the CFO at that time were both founders from the cake box shops. They're especially the CEO is a real commercial guy. He wants to grow. He's a real entrepreneur, and they lost track of what was needed to have a listed company. And at some point, they just copied the old annual report and partially put in the new numbers and forgot to erase lines of the old company report so that the numbers didn't add up. The RNS numbers, the one they file at London Stock Exchange, they were correct, but the annual report wasn't. And that's, yeah, a lot of people got scared back then because there was a pastry shop in England as well that went bankrupt due to fraud. So they saw the same thing happening again, which wasn't. It grew too fast. They couldn't cope. They didn't have the control structures in place. The management wasn't sufficient enough. The CFO got fired over it. So that's now there was an interim CFO. Now there's a new CFO that has experience in franchise businesses. So the structure is now solid enough, and they're still making a lot of cash. Yeah, they're like it's just a cash machine. So for now, it's still the dividend. I think it's 5 or 6% dividend yield. Um, but yeah, let's hope for an exit. Last summer, River Capital wanted to buy Cake Box. River Capital is a Australian, mostly private equity. They also have a small part listed, and they also own, I think it's a cheesecake factory. It's called in Australia. And then yeah, they wanted to buy Cake Box at £1.60, 160 pence. Management refused. And what we see now is that River Capital is buying even at prices higher than the 160 they offered before. So I think maybe a new offer could be coming. That's maybe a way as well to get some get paid. I hope it's not too soon because for now they're at 215 shops. Cake Box. They say they can grow to 400. So I would like to have some of that growth as well before they exit the stock market. But I see that as a real. I think that's at these prices. That's not a problem for Cake Box, but it's almost all UK listed stocks and smaller companies. They're so cheap that they're going to be taken private. I think. Yeah.
How do you make sure that it's not a fraud?
You can never be 100% sure. We all remember Enron wildcard. There, even if big audit firms go over it, we're never 100% sure. But we could visit the shop. We saw that those franchisees were actually so enthusiastic. They called it life changing to be a franchisee. They were very happy to be there, and then they said they were almost like a family. During Corona was a difficult time. They helped each other. They could count on the headquarters. So I think that's an important factor. And then just small tests. Cakebox has the franchisees who have shops, and then they also had kiosks in supermarkets. And if you went online, you saw that there were always good reviews about the shops, and then the kiosks got bad food reviews because the cakes weren't refreshed enough. I'm going to say something. I don't know the exact hours, but let's say they put in the cakes at 11 o'clock, And then if you got in the next day at 9 or 10 o'clock, you had the old cakes. They weren't taken out fast enough, so they were stale. And then up past 11, they were new. When I saw those reviews, I messaged the company and saying them, well, there's a problem there. You need to fix that because you're getting bad reviews even for your franchisees for the kiosks because people say Cake Box is Cake Box. They don't care which franchisee or if it's a kiosk. And you get a response, you get a pretty fast response, and you see them acting on it. The kiosks were better managed after that, just by us as a small fund sending a mail to them. So that's that's small. If you get reaction and you get an immediate reaction and a detailed reaction, most of the time it's not a fraud. If it's a fraud, and I'm sad to say I have experienced the fraud in my past with private equity. Um, there are triggers. The way they say things, the way they keep it more vague. They don't go into detail, or if they give details, then it's strange details, wanting to overthrow your thinking. So that's maybe through experience. You're never 100% sure, but I hope that through that experience, I learned enough to see when it's a red flag or not. And usually, you can find it in the numbers as well in the annual reports. And now with the accounting issues, indeed, you could say, how can you be sure the way they reacted on it? And the numbers in the RNS report were correct. So if you had Capital IQ or Bloomberg Terminal, you wouldn't even have noticed if you didn't read the annual report as well, because the numbers were correct there, but not just the layout, the thing they give to the public was just made up wrong.
Don't let the intern do your annual report. It's not a good idea.
Yeah, I don't know if it was the intern. He was also going through a divorce at the time, the CFO back then, and I think it was just too much, and maybe not not having uh, not having the structure of interns and subordinates to do the job as well, just growing too fast.
What could you have gotten potentially wrong in this investment?
Um, I think the if there's something wrong, then it's the growth. If they don't manage to get from those 215 to 400 shops, then they're worth less than we think. But still, we have enough margin of safety to still earn enough. Then it's not maybe a double from these. A bit less than a double, then maybe it's just 30 or 40% undervalued. I think that's the biggest assumptions we could have wrong. That's the growth. If they don't manage to keep growing. And what we don't want to see is them entering other countries. As I said, I don't think the cakes are good enough to enter Europe. Uh, so if they want to enter Europe, I think a lot of money will be lost on trying to gain market share that they will eventually have to abandon or step up their game. But I don't think I don't see anyone in my neighborhood or in my family eating those cakes when we have a bakery next to it that has the cakes we're used to. Maybe it's just that. Maybe it's just that we're used to, but it doesn't match our tastes.
How do you think about the exit at this investment?
For now, it's we just want to see it grow, and if they reach fair value um, at a point where the growth is progressed far enough, let's say 300 or 350 franchisees, I think we will exit because over that the growth isn't dominant anymore. For now, it's growing, and we don't think of the next exit yet. Um, if the price keeps at this point, I think we will be forced to exit because of private equity taking it public, not private. Sorry. Yeah. So it's not a real concern for us at the moment. The exit.
Let's move to the last part of the interview about portfolio construction. So, how do you think about portfolio construction? What is your general framework there?
I already mentioned it earlier that we divided in three parts. So the holding companies is the capital buffer to see if we can do redemptions or to just park money when we say we don't have enough ideas. I, and after that, if it would be possible to have the whole portfolio, all quality companies at decent prices. We don't invest more than 10% in a company at purchase. That's a rule we set for ourselves. It's not a legal rule. In the structure we have, we can have 30% in one company, but we don't want to invest that in the company. So the core positions we typically buy about between 5 and 8%, and then we think you just let them grow. That's maybe a lazy way of capital allocation. If a company performs well, we are not going to diminish the position just to have money taken out. We will just let it grow, and that way we think winners will take care of the capital allocation itself. If your bad companies diminish in price, they will get a lower percentage in your fund, and the ones that perform well get a higher percentage in your fund, just naturally. So, but we do make a distinction: the core holdings between 5 and 8% in buying, and for the value plays, it's between 2.5 to 4% that buy originally. But we have value plays now that are almost 6% of the portfolio that grew from 2.5 to 6%. So we don't exit them as long as we think the fair value isn't reached. We see no need into diminishing positions just because of getting some money off the table. As long as we think it's undervalued, just let them grow. That's a pretty, yeah, maybe lazy way of capital allocation, but it has worked in the past. So I hope it will still work in the future.
Are there any other factors you think about in portfolio construction? Because, like the quality of the cash flows, the differentiation between the cash flows, or
We do make sure that we don't. We have about maybe 20 to 25 stocks in our portfolio, so it isn't highly concentrated and it isn't diversified that much. We just think that that's the sweet spot we can manage. So that's something we also look at. If we go above that number, we will sell another company if we think we have found a better one, just to not have too many companies to worry about, actually. So that's also part of the construction of the portfolio. Then I think we don't want to have five automobile manufacturers. They're all pretty undervalued. Stellantis, BMW, Mercedes. I think people are exaggerating what's coming to us. Maybe some are not. But I think the Chinese manufacturers will come. It will hurt profits. But I think Stellantis, for example, is pretty decent in anticipating. They took a small position in a Chinese manufacturer as well. They will do distribution outside of China for that manufacturer. They when we bought, it's more than a double. It's one of those that went from 2.5% to 6%. So I don't think it's a buy anymore, but I don't see it as a sell. But we don't want and Stellantis and BMW, for example. We will choose one. We don't want that big exposure. I said we had three construction companies as well, but those three construction companies together make up 5.5% of the portfolio. So we see them as one position, not three, just three different companies, but one. Mentally, it's one position for us. So that's something we look at as well. So that not all, even if it's cheap, a whole sector can be cheap. We don't want to be too heavily weighted in that sector. We want to be diversified enough. I mean, I think we can do that with 20, 24, 25 companies. So not more. No. And you won't see us drop below 15 companies, for example. I think that even if it are the best companies in the world, as I said, we have to still have that mindset of disruption. We don't want one portfolio hurting us one company hurting us that bad. If if you are in a business and you can't see the disruption coming, then if you're not in the business, you won't see it coming as well. That's something we're really ingrained with. So that's why we want the diversification.
Starting with the Photoshop helps you here.
Yeah, exactly.
We covered a lot of ground in this interview, Sam. So for the end, there's always a chance to add anything we haven't discussed or you want to go deeper into. So is there anything to add?
Not really. Just that I'm very looking forward to meeting you in real life in Omaha. So that's if for the good investing community, if you're in Omaha as well, I would be very happy to meet you all. I think that's the one thing I'm most looking forward to this year. It's my first time in Omaha. Sadly, I had it planned last year, couldn't go because of a move. Missed Charlie, but yeah.
You will at least experience Warren and some of my bad jokes as well, hopefully.
Yeah.
Great. Happy to see you then in person in Omaha. And thank you very much to the audience to listening to the interview. And thanks for coming on, Sam.
Yeah. Thank you.
And bye-bye.
Bye.
I really hoped you enjoyed this conversation. If you did, please leave a like and a comment and for sure subscribe to my channel. Traditionally, I want to close this conversation with the disclaimer. So here you can find the disclaimer. It says, please do your own work. This is no recommendation. What we are doing here is just a qualified talk that helps you, but it's no recommendation. Please always do your own work. Thank you and hope to see you in the next episode. Bye bye.